Intro. Today we're unpacking a theme that keeps surfacing in conversations about money, markets, and the future of savings, the debasement trade, sparked recently by a Cointelegraph interview with James Lavish. This idea is gaining traction among investors who believe central bank policies are quietly eroding the purchasing power of fiat currencies. If you've been wondering why gold and Bitcoin keep showing up on people's radar, this episode will walk you through the logic behind that shift and what it could mean going forward. What the debasement trade means. At its core, the debasement trade is simple. Investors buy assets that can protect them from falling fiat value. Historically, that's meant gold and real assets. Increasingly, it also means digital assets like Bitcoin. The premise is that when central banks expand money supplies and keep interest rates low, the real value of currency declines. Investors respond by reallocating into stores of value they believe will hold up better over time. Why Bitcoin is part of the conversation. Bitcoin is often described as digital gold for a reason. Its capped supply and decentralized issuance contrast sharply with fiat systems that can expand at policy discretion. For investors worried about money printing and currency debasement, Bitcoin presents an alternative, one that's not controlled by any single government or central bank. That doesn't make it a perfect hedge, but it does explain why interest in Bitcoin rises during debates about monetary policy and inflation risk. The central bank connection. Central banks sit at the center of this debate because their actions, quantitative easing, balance sheet expansion, rate cuts, have direct effects on currency purchasing power. When people perceive those policies as likely to continue or accelerate, demand for assets outside the fiat system tends to rise. That dynamic is what proponents of the debasement trade point to when justifying allocations to gold, Bitcoin, and other perceived safe havens. Volatility, uncertainty, and investor behavior. It's important to be clear. The same forces that push investors toward alternative stores of value also create volatility. Bitcoin's price history is a reminder that protection can come with wide swings. In uncertain markets, some investors accept that volatility in exchange for potential long-term preservation of purchasing power, while others prefer more traditional hedges or diversified exposure. Looking ahead, if the debasement trade continues to gain mainstream attention, assets viewed as reliable stores of value are likely to remain part of many portfolios. Bitcoin's role may grow as more investors and institutions weigh its properties against the risks of fiat devaluation. That said, outcomes depend on policy decisions, market adoption, and broader economic trends, so this remains an evolving story rather than a settled fact. Closing. The rise of the debasement trade is a reminder that monetary policy and investor psychology are deeply intertwined. Whether you see Bitcoin as a revolutionary hedge or a speculative asset, its growing presence in this debate is hard to ignore. Keep watching policy moves and market behavior, and remember, diversification and informed judgment still matter.